I admire your luck, Mr. Bond. James.
That's right. Today is all about the bonds, the James bonds. So, Kimosabe here. Been noticing a lot of very interesting things going on here in the bond market. And let's start off with a TLT here on a 2 week chart. Ever since its inception, this ETF started trading in 2003. And you can see 20 years later, we're at the same levels that we were at 20 years ago. This is pretty crazy. But if you think about there was a video that I made about Sir Isaac Newton, one of the laws of thermodynamics, how every action would have an equal and opposite reaction. And that's kind of what this all kind of looks like to me. You definitely had a reversal here. This is looking bad. And this is your debt market because the market no longer wants to buy this debt, or that's the way it seems. And this does not appear to be finished just yet. It still looks like it has another leg down, and it would take out those lows, kind of projecting. Well, let's draw it out. I'll draw this out on a 2 week chart. And I do think there is a buying opportunity here on TLT coming very soon. This does look like an accumulation. You see all the volume here. That's whoever's been holding this debt has been kind of capitulating the debt, but somebody's buying it up. But I think it's just a buy opportunity for a bounce, seeing as you have a lower low closures going on. I would expect a lower high to come in here at some point. But let's draw out the pattern that I'm seeing currently. The way I was looking at this was some kind of A, B, C right there. And I was matching this leg with these legs here. And now moving in for this final leg here, which my projected target idea is 76, maybe as low as 75 for the potential buy setup. And that would complete this move. And I would expect a bounce to come out of here. Now, this could be on the back of like a recession happening or a deflationary event where people are seeking safety and they exit like the stock market and jump into treasury bonds, because this is due for a bounce. It really is. You do have what looks like an accumulation range where you have preliminary support there. Here's your selling climax. Here's your automatic reaction. And now you're going down for a spring, and you're likely to come back up here and take this liquidity up here, probably meeting somewhere around the 120 range, 130 area on a bounce, on like a panic bounce, maybe a recession or a deflationary bust quick. But like I said, this being your low, and you're going to have a lower low close here. Here's your high. I'd be looking for a lower high to come in there for this pattern. It'll just be a bounce, and then you have more devaluation of the debt thereafter. And that's just due to proliferation of the debt. They're just making too much of it. There's too much supply coming in. The U.S. government is just pushing too much debt into the market, and there's not as much interest in buying it. And how do you spark the interest? Well, you have a deflationary event, deflationary bust. So look for this to bounce back up, find support at previous support, and kind of go into a bouncing phase up to there. That's kind of the way it looks. Now, the other end of the spectrum here, I'm going to use the US 10-year yield. This is the yield chart. Whenever this goes up, the actual price of these bonds moves down. So when they're in a downtrend, this will move up. This will be in an uptrend. The reason being is because the government has to offer a better yield, being 5% or 4%, on debt that's getting devalued, because nobody wants it. So in order to incentivize people to buy it, they have to raise the yield. They have to offer a better yield on it. Otherwise, nobody wants it. And currently, we have some kind of breakout happening here. Now, that doesn't necessarily mean much until, the weekly closes maybe higher than that. Then you'd have a higher high close, and then you'd buy the higher low and go up. But this kind of speaks to the debt kind of capitulating down, the actual bond, the underlying bond of this yield moving down as this spikes up. And the target on that could just be this leg repeating up here, getting up to a 6% yield or something like that. Or it could be a pretty big spike up to 8 to 10% yield on the 10-year, and that would be pretty bad for overall markets and even the economy, because this is basically the cost of borrowing money. And if the cost of borrowing money is at 10%, you're less likely to borrow that money to invest into your business, or to renovate your business, or upkeep your business, or even for new supplies. If you were to need investment into your business, you got to think 10% of that is gone to the interest rate. The same thing goes for the U.S. government here, where they'd be paying 10% on debt. Unfortunately, this looks like what's going to be happening in the future. Back in 1982, when you had the yields at their highest at 16%, it's been in a steady downtrend, for 40 years. This was a 40-year bond bull market, as the yields, they did not have to offer as good a yield on it because there was so much demand for those treasuries, and they just kept moving up in price. So the yield got crappier and crappier. But now we fast forward to the past decade, past 15 years or so, since the 2009 great financial crisis. You've had what looks like an accumulation on the yield. Now, that doesn't mean accumulation on the underlying, but this does look like a Wyckoff pattern. But ultimately, it resolves in this is a change in behavior. So you have a higher high close here. If I was to trade any other chart, I would do the same thing. Say I have a higher high, I would expect a higher low to come out of here, maybe along this red trend line after the breakout that it experienced there. But this might stay above this accumulation box. This will be a show of strength, and it might just chop higher up here and move up. We might see 16% yield on debts coming in the future if nobody wants to buy the U.S. Treasuries. I mean, this is just the 10-year Treasury, but that could be kind of telling a story of all the rest of the debt, and that leads to the 20-year, 30-year, or even your mortgages. They could all require higher yield for anybody to be interested to buy it. So on this, I'm same difference with the every action has an equal and opposite reaction. You see how much lower that went than this box. Maybe it goes that much higher on the other side of that, and that's an equal and opposite reaction before it settles down a bit. So that could speak to debt collapsing very briefly and then balancing itself out somehow. I don't know how, but if you just go by the idea that it's going to move a similar amount to this above the box, above this range, that would be an equal and opposite reaction up to 8%, maybe 9%, even higher potentially. Depends on how bad it gets, but you got to think that would freeze up the economy pretty quickly. So you would maybe have a spike up in your S&P 500, Dow Jones, gold, Bitcoin, things like that on this debt super spike, and then reverse sharply because the economy would tighten up very quickly due to lending constraints. Now we look at the yield curve between the 10-year yield and the 2-year yield, the predictor of recessions. Yield curve is indicative of a tightening economy. And you can see ever since 1989 how much more volatility we've been getting. And it's just moving a heck of a lot more, especially since the great financial crisis here in 2008, 2009, all the way till 2011. And every time it inverts, it reverts and accelerates up, and that spells danger. I am wondering if, due to the debt cycle, that this time is actually different. Not that the economy won't do very, very poorly, but if markets will interpret this differently in the short term before getting a deflationary bust, you might have a super spike before this really, really gets going. So, given the yield on the 10-year bond, it may be different. It may be slightly different. This may act differently. We may see something different come out. Just a thought that I've been having over the past few weeks when I was thinking about this. But yeah, one of the most dangerous things that you could say is this time is different, when historically it does the same thing. It enters into very sharp recessions, and seemingly getting sharper and more extravagant as time goes on. So there may be an even bigger move up. This may move up even higher. Or maybe it doesn't move up as high. Maybe we get a little something like the year 2000s. Or it gets worse, like something we've never seen before, up to like 25% in between the two. But yeah, this is back above the 1% line, which is the danger zone. But it spent so long down here by comparison of those others. Those others were just dipped down very briefly and then recession. This one has just been grinding down here, just figuring out what it wants to do, and now it's popping us, telling us it's about time. But time for what? I think the markets are going to offer some surprises. I think things could play out differently than expected. It could get extremely volatile, and we're probably going to see some things that we've never seen before. Brings me to the S&P 500, kind of the proxy for the overall economy. Um, and still thinking about the Sir Isaac Newton, every action has an equal and opposite reaction. Look at how equal and opposite this is from that spike down in the yields on the 10-year, or even the spike up on the TLT, and how it's kind of doing the opposite. It's an equal and opposite reaction. And this is doing a nice little ABC, three-legged move, equal and opposite reaction. Maybe it's going to be perfectly equal. If you take it from the low, project from the low to high, I mean, maybe you're getting up to 64 to 7,000 would be an equal and opposite reaction. Doesn't necessarily have to get that high. I think it's done well where it's at now. Um, that suffices for an equal and opposite reaction. So then I have to think what would happen if debt spikes up, or the yield spikes up, and debt is selling off. What does that mean for these companies? Because they're not going to be able to borrow. Any company in the S&P 500, their borrowing cost goes up just like everybody else's, and that will constrain their business from being able to expand, research and development, all that. They're going to have higher operating costs. They're not going to be as profitable. So that would suggest this may have topped and it's going to run down with the debt spike. But you could also have this just pop up really quickly to grab liquidity, and then the economic downturn can start after this gets a blow off, similar to the way this started. It gets another blow off type of move. Or maybe we just have a sharp move down out of here. Thinking about, I mean, Trump is going to be taking office soon. And let's see, February 2018. Where did he take office last time? It was, yeah, February, March of 2016. And you had this kind of grind up. And then it was sideways. And you had grinding up for, well, almost 2 years of grinding up. Now you've kind of already been grinding up. So maybe this choppy pattern repeats during Trump's presidency. Who knows? Let's see when Trump took or left office. When would he have left office? That would have been 2021 in January. So somewhere around right there is where Trump left office. Thinking about this spike down here, same amount of time frame after he gets into office, maybe? Nah, probably not. But it's setting up pretty nicely for at least a spike down like that, if not probably worse. If the money printer does, for some reason, start, for some reason, you could have that COVID type of crash happening from here and then pop back up and repeat this pattern as like a triangle before it pops up again. And that could have something to do with debt getting devalued, and there's nowhere for the bond market to put their money because they don't want the debt anymore. And the bond market is the most liquid market on the planet. It is the largest market on the planet. It's I forget how much larger, but like 10 times larger than US equities. The bond market is where the big money plays. And there's so much money in there that if the bond market has money fleeing from there, you're going to see anything that is the opposite of debt go bananas, most likely. And that could be some companies in the S&P 500. There may be some speculation where the bond market just floods into equities because it is a very liquid market as well. But if you think about what is the opposite of debt, my mind immediately goes to gold. Right? Gold is the epitome of the opposite of debt. It's a physical asset that represents money that you hold. It's yours. It's the opposite of debt. So I could see the bond market flowing into this and having a very, very nice uptrend as the debt gets devalued. It has to devalue against something. May as well be gold. So I could see the bond market pouring into gold. Just people are tired of debt, or anybody that's in the bond market or sovereign nations are tired of holding U.S. debt because it's just getting devalued, and they fled themselves into gold. And of course, there's Bitcoin, which Bitcoin is the opposite of debt. This is also the epitome of being the opposite of debt. It's a sovereign bit of code that you hold yourself. You can hold it yourself, and it's unconfiscatable, and it's not debt. So anything that's not debt, I would expect to do fairly well in the future. And this whole pattern here since 2018, this can be all reaccumulation before continuation of markup. So this could be a digital way to kind of replace the bond market and restore trust because it is a trustless system. Pretty interesting to think about that this is either going to zero or it's going to 10 million. It's an asymmetric bet. Currently, you're wagering $94,000 per Bitcoin that it's going higher, and your risk is 94,000. So it could go extremely way higher, or it's going to zero. So your risk versus reward is still pretty decent here. Even the price is fairly high. The risk versus reward is still pretty good from thinking years in the future and the potential of this to help out the bond market or even replace the bond market potentially. Your risk versus reward is you're risking 100,000 for millions potentially. So yeah, don't sleep on it. A lot of people will say, or I've heard a lot of people say, it's a bubble. It's a scam, it's a Ponzi, it's a bubble. Well, bubbles don't keep bubbling. This has bubbled so many times. I think it's done being called a bubble. Will it retrace? Yeah, probably. But it keeps retracing into higher lows. It keeps finding demand as it's moving up. So um, look for your buy setups. I mean, on a very, very large time frame, what we have here is a higher high than previous cycle high. So that should tell you the next cycle, look to buy the higher low on a larger time frame on like a monthly scale. Higher high, buy the higher low, just like its entire history, until it shows you differently. You would have to close a lower low below 15,000, close a lower low, then you could sell the lower high and expect a buy set up a little bit lower. Yeah, that's kind of the bond market and how it all kind of ties into equal and opposite reactions to very, very large markets and large time frames, and how debt could see a spike in things that are not debt related. So, like Bitcoin could be setting up for a spike up on a debt collapse, and then the economy collapses, and then Bitcoin can retrace back down as there's no more money flowing and the economy's freezing up, or we have power grid failures, or whatever you want to see. Um, but on a debt collapse, that may be the catalyst that sends this up decently high, um, into a peak, into euphoria maybe, and maybe it just stays up there. I'm not one to say where price is going, but um, that could lead to very high prices very quickly. If price does get up to 180 very quickly, I'd say that may be a time that it's going to retrace and do something different. And that would be kind of the inverse of what happened with COVID, kind of similar there, how it would just spike up. So then you would take the 1-to-1 fib extension of that. Same thing as the S&P 500 or other bond markets, or the yield. And you just take the 1-to-1 fib measurement there. So an equal and opposite reaction, it gets you to 240,000 before repeating this structure up here. That could be in the cards. So if there is some kind of super spike on a debt collapse, then it's like the inverse COVID. It's like doing the opposite reaction of COVID. It's like going the other way, as the bond market is doing the opposite that it did in COVID, where the 20-year or the TLT at the beginning of the video spiked up, and that was the bond market peak on the TLT, and now it's going to go break the lows. It's doing the exact opposite. Now Bitcoin potentially is making an ABC up here into 200 something thousand maybe on a debt collapse before repeating some kind of ABC like that into the next cycle low. And I could see gold doing the same thing. Gold could be spiking up very sharply up to 3,000, 3,500 even, on some kind of debt collapse. So watch the debt market. The debt market is looking like the canary in the coal mine. That looks to be what's shaping up to be the problem, based upon the precious metals market, based upon what Bitcoin's been doing, and based upon the 10-year yield and the yield curve inversion. It's all telling the story that you're about to have markets move and probably reverse very sharply on those moves. So that's kind of what I'm seeing. Sorry for the long video and the rant and the thoughts. But yeah, let me know your thoughts. Leave your thoughts in the in the comment section. Let me know what you think. But yeah, that's kind of what I'm seeing. Just super spike, equal and opposite reactions from the COVID low to that. Yeah, something to think about. Yeah, keep your stops tight and have a good night.